Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Josh Hochberg, Managing Director, Chief Operating Officer with U.S. Financial Communications at Edelman, to discuss the 2021 Edelman Trust Barometer special report, which surveyed 700 institutional investors across 7 markets. Josh, it's great to see you again. Welcome back to Trade Talks.
Great to see you, Jill. Thanks for having me.
What are some of the pivotal issues the survey examined? Are there any trends that have emerged over the past few surveys that stand out?
Sure. Well, look, ESG is still the dominant theme. It was last year, continues to be this year. It should not come as a surprise to anyone that institutional investors still expect management teams and boards to have direct engagement on things like climate risk, corporate culture, diversity and inclusion. As a matter of fact, 90% of institutional investors surveyed agreed that they subject ESG to the same scrutiny as operational and financial considerations. This year, however, may be a little bit different. Our survey found that while ESG remains a priority, investors do not necessarily trust the ESG metrics that companies are disclosing.
Yeah, and the survey showed building ESG trust is an uphill battle. What are some of the issues concerning investors?
Yeah, so there's some really interesting data that came out this year. 82% of investors on a global basis believe that companies frequently overstate or exaggerate their ESG progress. So there's really that problem with trust there. 72% of investors on a global basis also do not trust companies to achieve their stated sustainability, ESG, or DEI commitments. So as a result, investors are looking for more government mandates around ESG disclosure. 85% of investors on a global basis believe that the government should apply more pressure to enforce ESG compliance. So compliance and disclosure regulation are absolutely top of mind, with a lot more work to do around this.
Well, ESG success is obviously critical, but Josh, don't investors still tend to focus more on fundamental financial metrics?
So each year we take a step back and look at our survey, and we certainly understand and acknowledge the importance that ESG has played in our survey over the last couple of years. But we wanted to take a step back and ensure that that's really the reality of the market. Last year, there was no doubt that ESG was becoming critical to investors, but the pandemic caused investors to give some grace to companies so that they can deal with the challenges they were facing and, frankly, continue to face. This year, our survey reveals that investors have not taken their foot off the pedal in terms of ESG. As a matter of fact, in the US, 90% of investors agree that a company with strong ESG performance deserve a premium valuation to its share price, and 90% agree that companies that prioritize ESG integration represent a better opportunity for long-term returns than those that don't. So here's the caveat, though, just to make sure our feet are appropriately planted on earth. When we asked investors what drive trust for them, they still noted financial performance and products and services right at the top of their lists.
Yeah. Have traditional investors changed how they engage with public companies?
Well, our survey showed this year that all investors, including investors that do not traditionally take an activist approach, believe they now have an obligation to take a more active approach in their investments. In the US, an astounding 95% of investors are more interested in taking an activist approach to investing. And our survey cuts across a wide swath of the investor landscape. As you said, 700 investors across 7 countries, representing trillions of dollars in assets under management. So it's really a good guide for how the market's thinking. But what's maybe as interesting is when we ask them about the specific ways their firms are being more activist, 74% said they would take an aggressive activist measure. So that includes pressuring management for operational or governance changes and publicizing concerns they have with a company strategy.
So how are investors viewing employee activism?
Well, this was, for me, the most fascinating part of our survey this year. If you go back to as recently as 2019, our survey showed that 74% of global investors agree that companies with active employees are less attractive investments. Less attractive investments as early as 2019. This year, that sentiment was completely turned on its head, as the same percentage, 74%, now believe that employee activism within a company is indicative of a healthy workplace culture, good leadership, and a highly engaged workforce. It's clear that investors are now recognizing the importance of the engaged employee and the changes they can affect within an organization. Quite a difference over the past few years.
Well, to wrap up here, and I know this is the first time I've ever asked you this, Josh, after covering this for a number of years, have institutional investors been influenced by the meme stock phenomenon?
We could not have a survey this year without talking about the meme stocks. And the answer is absolutely. 87% of the investors in the US agree that Wall Street bets and other online communities influence investment decisions. And 90% agree that these online communities can create false markets. The sentiment seems to be running deep across institutions, as 89% of US investors believe that meme stocks represent a targeted attack against institutional investors. Think about that, a targeted attack against them. So the retail community is certainly gaining power, and institutional investors are paying attention.
All right, Josh, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.